NIO just changed the conversation again. The company is coming off a new monthly record in China and is pushing deeper into a next-gen battery swap rollout, while Beijing tightens export rules that will reshape how every Chinese EV maker competes abroad. On top of that, coverage this week shows NIO keeping pace with the strongest local rivals, and the stock has been reacting fast. If you want a clean, data-backed view on whether this move has real legs, you are in the right place. Hit subscribe and let's lock in on what actually moved sentiment in the past few days and how to position without chasing. This week's shift starts with confirmation that NIO entered the fall with fresh momentum in its home market. Multiple outlets reported that September set a new internal high for monthly deliveries and that the broader trio of NIO, Li Auto and XPeng collectively advanced year-on-year even as some peers lagged. That matters because it tells you the demand pulse is not isolated to a single model or one headline day. It is a market share conversation that is actually moving, and NIO is part of that move right now. These pieces also note the competitive scoreboard, with XPeng and Xiaomi posting big numbers of their own while BYD's overall total dipped year-over-year. This is the backdrop that feeds traders the confidence to step in on green days and explains why dips are getting bought faster than earlier this summer. Now layer in a different kind of catalyst. NIO's power strategy is pivoting toward a new generation of battery swap. Over the last few days, management commentary flagged that 5th generation stations are scheduled to start rolling out early next year, and that resources are being shifted toward the next-gen system rather than brute forcing this year's station count. That is a strategic choice. It prioritizes station throughput and cost per swap over raw installation totals. If the next-gen hardware reduces service time and labor per swap while boosting utilization, you get a better margin story without needing to overbuild. This is not a promise, it is a design target. But the decision to slow current gen adds and redirect to the next architecture is exactly how you signal confidence that technology, not just CapEx, will do the heavy lifting. There is also fresh connective tissue with the battery supply chain. Reporting in the last 24 hours revisited NIO's ties with CATL, including CATL's investment into NIO Power and joint work around advanced chemistries and swapping standards. The key is not the headline itself, it is the direction of travel. If the dominant cell maker in China keeps aligning with NIO's swap ecosystem, the probability of wider compatibility and better economics increases. It is easier to build a moat when your moat lines up with the market's biggest shovel. Great stories still need oxygen, and policy can choke a rally fast. In the last week, Beijing confirmed that starting in 2026, EV makers must obtain export permits. Europe is also tightening scrutiny of Chinese autos. None of that hits NIO's domestic momentum today, but it absolutely changes how analysts handicap international growth, especially for brands planning to scale exports in 2026 and beyond. The right way to think about it is simple. Domestic execution has to carry more of the valuation until the export permit regime is clear and trade friction stops escalating. If NIO's next-gen swap and product cadence keep domestic share trending up, you can still get a re-rate even while export visibility is fuzzy. If domestic share stumbles, the policy fog turns every pullback into a magnet. On competition, this week's league table is blunt. XPeng put up a monster print, Xiaomi stayed hot, and BYD's headline total eased while pure battery electric still rose. For NIO, the lesson is focus. The company does not need to outrun every rival on raw units to win the stock. It needs to prove that its 3-layer brand strategy and swap network deliver a stickier customer base and better lifetime economics. If churn stays low and station utilization climbs as next-gen hardware hits, you get leverage the market will pay for. If utilization stalls and rivals win repeat buyers on price alone, the crowd will treat swapping as a cost center again. The next few weeks are where that narrative firms up. Here is how to navigate the next stretch without repeating the old playbook. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. First, anchor to what is fresh and in play. We have a new monthly high confirmed by company and media, a documented pivot toward 5th gen swap starting early next year, and clear policy signals about export permits. Those 3 items, all from the last weeks, define your risk and your edge. Second, watch how price reacts on macro moves. In sessions where the 10-year eases and Chinese tech catches a bid, NIO has been correlating positively with local peers. That correlation is your tell that sentiment is broadening beyond the one-name squeeze and into a China EV basket trade. Third, respect the scoreboard. With rivals printing big wins, every NIO update that reinforces product traction and network efficiency matters double. That is why the market is hypersensitive to any hint about next-gen station timing and capabilities. Let's talk positioning without repeating the numbers you are tired of hearing. If you are building exposure, do it around proof, not hope. Proof in this tape looks like continued confirmation that station rollouts are shifting to the new architecture on the timeline management just outlined, and that utilization is rising even as incremental station adds moderate. Proof also looks like the stock holding green on days when the China complex is weak, which tells you buyers are stepping in for name-specific reasons rather than riding a basket. If those proofs show up, you can lean into strength. If they do not, let the noise pass and buy the next clean setup. That is how you avoid getting trapped in repetitive headline trades and keep your average cost sane. This week gave you something new to measure, not a recycled delivery total, a trajectory, a next-gen swap schedule that chooses efficiency over vanity counts, a policy shift that requires real planning for exports, and a competitive board that is forcing sharper execution at home. If NIO converts that mix into higher station utilization, steadier domestic share, and smoother rollouts, the equity raise you hated turns into the reason the stock can re-rate. If those links break, the market will say so quickly. Either way, you will not need a rumor, you will see it in how the tape behaves around fresh updates. If this breakdown helped, tap subscribe. We will keep cutting through to the pieces that actually move price.